Another effective strategy is not to really even look at the prices really at all. You're looking at the moving averages and how having more than one moving average and how it interacts with each other. So you're looking for price crossovers, you're actually looking at moving average crossovers. So how that kind of works is you have one chart, you have your chart of your candlesticks, your prices, whatever is going on there. And you're using, a moving average with different timelines. You could even have different types, or they could be the same type, but they definitely have to have different timelines as far as, days, minutes, hours, whatever your time frame is. And what you're looking for is not that the price is going to cross that moving average, but that a shorter timeline moving average is going to cross a longer timeline moving average. And we'll have some graphics here that'll show that in action and what to really look for. But think conceptually like not about price, two moving average lines, and then they're crossing over themselves is the idea. And then what do? Do you buy or sell based on that crossover is the idea. And we're going to talk about that. So for example, a real common way to do it, or combination, is have a 5-day moving average and a 20-day moving average is a common combination. You can see they're shorter time frames. And as an effect, you're comparing 1 week of prices, 5 trading days, and 1 month of trading, trading prices, or, 4 weeks times 5 is 20 days as far as being open, markets being open, closed 2 days a week, open 5 days a week. So that's a common way where you're looking at a week versus a month, and are they crossing over? However, you can choose and experiment with your own timelines, and that's perfectly okay. A lot of people use 50-day versus 200-day moving averages. There's lots of different ways you can do it. But a common one to get you started is like a 5-day and 20-day moving averages. So what you do is when you buy, when the shorter time frame moving average line crosses the longer moving average line on the upside. So you've got this longer moving average line, and the shorter one is crossed above that line. So by the same token, you sell when the shorter moving average line crosses the longer moving average on the downside. So it's going down below it, so you've got the shorter one is going to go below the longer one. And then the buy, of course, when the shorter one is going above the longer one. So let's look at this graphically so it makes a little more sense to us here. So if we look at this chart here, you can see we have a 5-day moving average in the blue and a 20-day moving average in the, we'll call it pink here. And you can see, let's go over to the far left. You can see how we have a real strong uptrend here on the far left. You can see that 5-day moving average prices, again, very sensitive because it's not a long time frame. Even though it's a simple moving average, it's not a weighted moving average, but you can see how it hugs to the prices. Versus the 20-day moving average, there's the kind of a gap between that blue and that pink line on the far left. And then you see them start to come together here in the middle where it's almost hard to see, but you'll see that blue line cross, a little bit, or start to cross below that pink line. Those are sell indicators that, we might be a little bit of a downtrend or an opportunity to sell, that we've topped out, and we're actually in a more of a sideways market, and it's kind of whipsawing a little bit there. But that would be our sell signal that the blue line, the shorter time frame, is going to cross, above and go below. It's going to go below the pink line. And then as we go a little bit further on, you're going to see a definite uptrend come again where that blue line 5-day is going to cross that 20-day, definitely cross it and go above it, and then keep going above it, and that would be a buy sign. And then so on and so on as we go across the chart. You can see the lines crossing each other, and each time there's a cross, that means that there is either a buying time or a buying indicator or a selling indicator as you go through those. And I've highlighted those here. You can see, where there's a sell, a buy, sell, buy, sell, buy, as far as looking at those when they cross over and when they go back up again. Again, if you have longer, let's say instead of a 5-day, I was using maybe a 40-day or 50-day moving average for the pink line, there might be less times where they might be crossing. So that's where you can, adjust those to see what's comfortable for you. But this is a classic way to do it, is with a 5-day and a 20-day, and you're looking for when the lines cross over, and this has nothing to do with the prices. You're looking at just the blue line and the pink line. It should correlate a little bit together as far as with the prices, but you can kind of see you're really looking at the lines more so than prices by looking at moving average crossover versus price crossing over a moving average line. In addition, if you see more space, or what you call daylight, between the two lines, you'd have more confidence that the signal is correct. So if we look over in the far left, or you can see where the arrows point, and the other two areas as well, there's a lot of daylight, a lot of space in between the blue and the pink line. So that gives us a confidence that, okay, this is pretty strong. It's going to probably keep going on that uptrend there, for example, on the far left. And so we feel pretty good. Once there's less daylight, which you can see in the first sell box, it starts to get all kind of messy there, all close together. Then there's less confidence that that sell signal is correct. That's not just going to whipsaw and go back to a buy signal. And then after that second buy signal, we see another big gap come up, and so we have a nice another run up in this particular security, where we can have confidence that that signal is correct, and then so on throughout the rest of the chart. So when you're looking for things with moving average crossovers, look for the crossover, but also look for looking back over time, how wide that gap is, how much daylight is there between the two lines to give you another extra level of confidence that you're making, the correct move on that. If we were to, let's say, lay on 3 moving averages, and let's say we wanted to have this almost be a filter where we're like, yeah, 2 crossing is good, but we want to make sure that all 3 are crossing to be really extra sure, you can do that actually. You could say, okay, I want my shortest time frame. It'll always be the shortest time frame. And let's say I've got the blue in 5 days, the pink in 20 days on this chart. And then I've added a moving average, a simple moving average of 60 days, right? So you can see to the left how there's a lot of daylight between the blue and the pink. But if you look between the blue and the pink and the green, there's a lot of daylight even between them. And you can see how if we follow that green line going up and where that blue arrow is saying approached but did not cross, you can see we go all the way across that chart for a long time frame before we actually cross all 3 lines, really somewhat significantly where we're crossing all 3 lines where the blue line is in effect crossing the pink line and the green line, those longer moving averages that are telling us a real sell signal. So if we did it this way, you can see how it takes out all that whipsawing that occurred earlier, that above and below the line, took all that out, and we've been holding the security all the way until we get to that sell part, and then we sell from there. And then as we get to the far right of the chart, we're waiting for a buy sign where it looks like on this chart, the blue line, the short time frame, has crossed the pink already, but we're waiting for it to cross that green one. And once it crosses that green one, then we're looking at another buying opportunity. But right now on this chart, long time we've held this particular security, we've sold it, and then now we're kind of watching it to see if there's an opportunity using 2 moving averages crossing each other for another buy opportunity, or if we just should just stay out of it. Another thought too is if your trading platform or software allows, you can even put more than 2 moving averages on there, or 3 or 4 or however many you want. You can even go up as high as 10. Depends on the trading platform. A lot of them top out at 10 or at 3. But if you can allow to put a whole bunch of them on there, then you'll get kind of this colored line effect that'll kind of create like a rainbow. So your shortest time frame is going to kind of move through the rainbow, and some people like that. But again, if you put on a lot of filters, you're going to have less trading opportunity, which might be good, certainly limiting whipsaws, but you might be giving up an opportunity when maybe you should have got out sooner, or you might miss a buying opportunity on the upside. So traditionally it's 2 moving averages, the shortest one crossing the longer one, but going 3 adds another extra layer of filtering basically on that, and gives you a little bit more confidence. And don't forget that length between a daylight here to give you more confidence too between the lines.